Good morning. We are on to a new module or subject under your credit management program. What I have to cover is the credit risk management. Credit risk management is part and parcel of the credit management. Here we have added one word here in between, the risk. So initially, I would like to ask for you to understand what is risk. Risk is definition of risk is in banking terms they say exposure to uncertainty. In other areas it could be a loss or injury. Generally what we say is if you are subject to risk, what will be the end result will be there will be a loss. If you have taken a risk in investment on an asset and the price of that asset varies with the market conditions, and as a result your earnings will go down. If it goes down, you have been subject to the risk involved in that particular investment. So risk has various definitions. Where credit is concerned, you know what is credit. Credit is bank's bread and butter, we call it, because main reasons for bank existence is to act as a mediator to fuel the economy. Now, in mediation role, we say banks does financial intermediation. What we do is we collect deposits from, we say, economic agents who have excess, those who are not willing to take risk with their own capital, but would like to deposit or invest in the institution which act as a intermediation. So banks provide that groundwork for agents with excess funds, and they accept deposits and pay interest on that. On the other hand, if bank is going to keep that money with them, you know very well, if money is kept idle, it will not earn any interest. So we may not be able to pay back the interest what we have agreed to our depositors. So what the bank's next role is to lend. Now, I said credit comes there. So we provide credit to the economic agents once again who lack capital but willing to take risk with somebody else's money and do a project or a business and more money, and with that they could be able to pay. So definition of risk here is we have a credit. We say credit is nowadays it's actually a right of everybody who is actually being qualified to get credit. And so those economic agents who are without additional funds for their businesses, they come to this financial intermediator, that's the bank, and then borrow. Once they borrow, the risk, they transfer part of the risk what they willing to take to the bank. And that risk is, we call credit risk, because you know very well when you give facilities by way of loans or drafts or any other kind of credit facilities, non-payment will involve risk to the bank. Whereas the money what they have taken from their depositors need to carry that fixed interest rates what they have been agreed. Whereas money lent is in the hands of the borrower, and if it is not been recovered, that risk will pass on to the financial intermediate, that's the bank. So in general terms, what we do is we take money from economic agents who have excess, we lend to economic agents who are lack of it, and difference between the interest spread what we quote in both transactions. That is, in a deposits, we'll say you pay 5% and you lend at 9%. Then you have a difference of 4%. We call it, that is our interest spread. And we live on that. So what we need to know is whether that difference or the interest surplus of interest or deposit rate what we pay is sufficient to cover the total risk and to manage our institution. So credit risk is definitely identified by one factor. You know very well this factor is, we call it non-performing assets or non-performing loans. We also call it a key risk indicator of credit risk. And so now you have a bit understanding of what is credit and what is risk. We also need to understand what is management. And you know very well, management is planning, organizing, and implementing certain tasks so that you achieve the goals what you set. So similarly, credit risk management is involve credit and taking of risk and management of that risk, so that original intended goal of that interest spread what I talked earlier will be achieved, so that bank could be a profitable organization. So going further, I would like initially to go into a type of risk a general bank has. Now we talk about credit risk, but bankers are subject to various type of risk. So it's good to know, apart from credit, what are the risk types we generally banks are subject to. You can see 3 rounds and you get a hub in yellow. Now, any organization, we say, are subject to these 4 major risk areas. You could see strategic risk, financial risk, operational risk, and also in between, we call it a regulatory or compliance risk. Now, our subject is the financial risk, because financial risk has 3 other elements. Those are credit, market, and liquidity. So we have very small portion of the type of risks bank takes. Very small portion, we call it credit. And however, as a bank, as an organization, may face different type of risk. We'll take strategic risk. Strategic risk is that is to do with customers and your suppliers, or the money comes from suppliers, that is your depositors. If you don't attract sufficient deposits, you will know you don't have that raw material to lend, which is money. So banks have strategies, different strategies to attract customers, investors. Then strategic means a long-term plan. So strategic risk is, if your plans are not successful, you will face strategic risk. Now say, for example, your bank decide to attract customers by offering high interest rates. Immediately your competitors know the fact. They also increase the interest rate to the same level. What will happen? Your intent of attracting those deposits at the rate what you thought may not be successful. Your strategy failed, and that failed strategy is called strategic risk. So bank is a very competitive, banks operate in a very competitive economic environment. You know, in Sri Lanka we have 26 banks, some 50 odd finance companies, all after these economic agents who have excess money, the deposits. to attract them, they have different strategies. Interest rate is not only the one strategy, but they have different products. If you think, I'll take example, a minor savings account. Banks now don't call them minor savings account, they give a brand name to it. You may have heard words like Arunalu, Tikiri, all those are brand names they have given to those products, mainly it is part of their strategy to attract minor savings deposits. Minor savings deposits will last very long. If a newborn child has been, if a parent decide to deposit money on behalf of a newborn child, and he may become after 18 years at the age. Until such time, the money will be in the bank. So that kind of strategy will fail. To attract that strategy, they have put brand names so that names will be remembered in the hearts and minds of parents. So moment the name sounds, they will go to that particular bank. So similar strategies are being followed by other institutions. So especially banks cannot have different strategies to another bank, especially because only one strategy can be differentiated. That is the great customer service what you can provide. Rest, interest rates, if you jack up your interest rates on deposits, your competitors will do. If you jack up your interest rate, what happens is your spread over credit will get diminished and you will be subject to low profitability. So they don't do that. Another strategy is to earn as much as possible so that our investors and our shareholders also could be compensated with the earnings what we make. Therefore, strategies has to have a balance and something to do with your competitors and something to do with your customers. So you've got to bear in mind this is one of the major risk area. If you fail in your strategies, there will be a failure in your bank also. So this is a part of, that's why the marketing department has huge budgets to do advertising, to do promotions. That is all that is to attract your clients and also be above your competitors. So we go into another area called operation risk. Banks now provide, we call it long time ago, until digitalization came in, banks we call it a brick and mortar operation. What is brick? Mortar is cement. Cement and bricks will make buildings. So buildings we call it branches. So if you want to do banking, in the earlier days, you need to go into a branch bank to do your banking, but it is not that now. With technologies been introduced to various delivery channels, like we have ATMs, we have internet banking, we have phone banking. So you could do your transactions, we call it 24/7 and 364 days a week, a year. So banking operations with these new channels been introduced has got really wide, because early operation is you open your doors at 9 o'clock, you close at 1:30. You are only exposed to the customers only for a very limited time. When you have that limited time, the risk of operations also get limited. You could be robbed during that time, but now you could be robbed at any time of the day because your internet bank is exposed to hackers. So operation risk has really widened in current era. So banks also pay a lot of attention to this area called operations. So operational risk is a failure of people, systems, and any other events like external events or internal fraud, external robbery or whatever are operational risk factors. So we move on to other area before we go into financial risk, which is how credit comes there. I will move on to what has been marked in this slide in yellow, and you could see the definition given is regulatory or compliance risk. Banks are subject to various regulatory conditions imposed by the regulator. Our regulator is, Central Bank of Sri Lanka. And this risk is that if you don't abide by the rules set by or directions given by the central bank, you will be subject to regulatory risk, or we call it compliance risk. And if you are violating all the compliances set by Central Bank of Sri Lanka, you could get fined, or if the violations are very severe, you could get even your license cancelled. So where banks are concerned, it's very necessary to have regulatory conditions because we accept public deposits. And protection of public deposits is one of the major area which central banks intend to provide under this compliance risk. So it's actually a prudential requirement of the bank also to provide customer safety where depositors safety of their deposits. So under that, we have this compliance risk, but now this area also has been expanded into various other areas, not only simple compliances. It also gives what type of liquidity bank should maintain, what type of customer service we provide. There is a customer charter that you can't just hoodwink your customers. You need to educate your customers of your product and make sure that they understand the transaction well. If not, you got to explain to them, and you need to provide all the charges, what you're going to levy on your customers. All that comes under this regulatory requirement. So if you violate that, I told you earlier, you may get fined or you get your license cancelled. Finally, so we come to our major area. Banks is a financial institution. Financial institutions have financial risk. Now, under that financial risk, there are three parts. Financial risk could occur from credit. That is, you take money from your depositors and you lend, and those borrowers didn't pay you, you will be subject to credit risk. Then, not only banks give loans, but they also invest this money in the market. Banks can invest in share market, bank can invest in gold, bank can invest in bonds and treasury bills. Those investments also should get a gain to the bank, or there must be some yield coming out of those investments. And the fluctuation of those yield, earnings will fluctuate in the bank. That is, we call it market risk. For instance, we'll take a very simple example. You decided to invest on a share which is currently trading at 100 rupees. So we'll say if bank wants 1 million shares, so they, if 100 rupees into 100 into 1 million, they will invest in this particular share. Now, after we'll say a month, the price of the share is, we'll say 90 rupees. What has happened? Your investment, face value of your investment has been declined by 10%. And that loss between your investment value and your current market value is your loss. That is, we call it market risk, or In other words, we also call it price risk. Also, this could happen if the interest rates were at high rate. Now, say a year ago, if you deposit money in the bank, you could earn something like 10 to 12%, or if you place for longer term, you could even get more. So, if you have invested 2 years ago on a 5-year deposit, we'll say the rate is 12%. Now, market rates are for 5 years, maybe 7%. What happens? Now, banks still continue to pay until the maturity date, which has another about 3 years to go at the rate of 12%, whereas they can get money in the market by way of deposit at 5%. Now, see, bank that way making a loss because of the fixed interest rate they have given on a deposits on a longer term, whereas interest rates have been fluctuated, and as a result, bank will suffer loss. This interest risk also a part of market risk. Then the other type is, we call it liquidity. Liquidity is banks need to maintain, we say there's a regulatory requirement of 21% of your total assets, liquid assets, you got to maintain by way of cash, treasury bills, bonds, in order, if there is a claim by a customer, you need to pay back. And if you fail to pay back, what happens is your reputation, once again, will be lost. And also, there will be other problems. There will be run on the bank. People will fear that bank is not doing well. All that will occur because if your liquidity is not right. So central bank also play a very keen role in maintenance of banks' liquidity. And other financial factor is called liquidity. You need to have money when there's a deposits being withdrawn up or even uplifted even prematurely. Banks carry a large amount of money in liquid form so that they could convert and pay cash to such customers. So these are the types. But apart from that, we have technology risk, because I told you we run on different platforms. Technology risk could be an attack on your system by a hacker, skimming of a card where a bank has to suffer a loss. All those are technological risk. Then also we do contracts with our customers, we contract with our investors, and if those contract obligations cannot be met, and if you've been sued, that will be legal risk. Then I told you about the reputation risk. Banks, customer confidence is so important. If a customer loses his confidence, I'm sure your major raw material, which is cash by way of deposits, will not come through. And once you lose reputation, it's very difficult to rebuild. Therefore, banks run on customer confidence, and that is, we also call it reputation. If you lose reputation, there will be other repercussions which are very damaging, and those risks cannot be cured very quickly. So this are the type of risk we face. But out of all these, we have a very limited area to learn under your credit management, which is financial risk. Part of financial risk is credit. So you see in this slide, what is credit risk? Credit risk is the potential for financial loss where a customer fails to repay his obligations or loans. In simple words, losses associated with default is also called credit risk. Now this is indicated by significant amount of assets. Now say your loan is assets for you. When you give a loan, it will go under your current assets. And when a current assets, if your returns are not coming, that means the value of that asset is being diminished. If it is, you may not be able, if a customer completely default, we call it that asset become a non-performing assets and it is worthless. So your assets becoming worthless also is a part of your credit risk. It could happen by way of, borrower unwilling to pay, or they had business losses. As a result, customer is unable to pay. So this is what you call credit risk. I'm going to I hope so far you are familiar, but it's better that I could go to the board and do some exercise with you. Uh, do you understand the balance sheet of a bank in simple words? Give me a second. I'm trying to leave this slide and then go to the board. Or I'll explain in such a way, but I couldn't play with this technology. Uh, so bank balance sheet is consist of, in a balance sheet we have current assets, we have current liabilities, and generally total assets are equal to total liabilities. Now in banks balance sheet, if you look at in a very simple way, it consists of current assets and fixed assets that made up the total assets. So we look at what are these current assets in the bank. In a normal trading organization, we say current assets include cash, debtors, and your stock. But in a bank, it is different. Bank, we have cash. Of course, banks need to maintain very high value of cash in order to repay our obligations to our deposit customers. So we have a cash. We generally say, if you take your total assets 100 billion, we'll say at least 90 billion are current assets, because banks fixed assets compared to the current assets is about 10%. That is your land and building, your machinery, your systems, and all that. Most of the banks still go on, your branch network or more or less on the rented premises. So they keep their fixed assets to about 10%. So if you have 100 billion total asset base, we'll say 90 billion is consist of your current assets. Now, out of this 90 billion total assets, there's a requirement banks need to maintain at least 7% in cash. In order to cash, I mean your counters, your vault, your ATM machines, and your current account balance with the central bank. So this percentage is about 7% of your total assets. So out of this 90 current assets, 7 will be kept in cash. Then you also do certain investments. I told you banks also run the risk of market risk because they don't lend all the money what you get from depositors, because in order to maintain the liquidity, they do investments in other areas like treasury bills, treasury bonds. They can invest in shares. They can buy gold as an investment. So we call it commodity. International banks also deal in other commodities like oil, different type of metal and all that. But in Sri Lanka, generally we have investments in government securities. Government securities include treasury bills and bonds. Then we also invest in the share market, the stock exchange, and we also, a lot of banks will deal with gold nowadays, and they buy and sell gold as part of investment. So this 7% we kept in cash. You need to make up your investments to make your liquid assets run up to about 21%. So we'll say 7 plus 14 will make 21. So banks will at least do investments of another 14 out of 100 billion, which I said, in treasury bill bonds and various other avenues for investments. What will be the balance left? Balance out of 90, if you leave 7 and 14, it will be about 69. 69 will represent, we call it advances or loans and advances. So loans and advances, which is the credit portion of what you see, 10% go for fixed assets, 7 in cash, 14 in investment, 69% of the total asset base is consist of loans and advances. You can see from your balance sheet, the major portion, 69%, is loans and advances. So the highest risk a bank pay where your balance sheet is concerned is the credit risk, because the most large portion of your assets is made up of credit or loans and advances what you have granted to your customers. So default of such a big amount will tend to have huge risk, and that risk is we call credit risk. So where balance sheet is concerned, the largest risk the bank run, I would say, is the credit risk. So it's very important that you need to keep your credit portfolio, total credit, loans and advances, in performing section. I would say, why I call it performing section means those, if any of those assets, that is credit which has default and go into non-performing, which will not earn you interest, as a result, you will run the credit risk. So credit risk has two parts, I would say, because you could run the credit risk by non-payment by your customers. We call it a counterparty risk. That means your customers have not paid your new money, but they have taken. Similarly, banks also could take different type of stance on selecting to whom to lend. As a result, we say you run most of your portfolios on one concentration. If you can, I can put it in such a easy to understand way. Central bank has, if you understand, central bank give a categorization of businesses, and those businesses will include agriculture, tourism, transport, construction, trade. So those are industry types which bank can lend money. And if a bank chooses, no, we would like only to lend to one sector. That is our preference sector. We'll say tourism. Soon after the war, tourism became a very big money earner. So if bank has thought that we will do all our loans even to tourist sector, what will happen now? Because of pandemic situation, now tourism is at one of the most riskiest industry. Then such customers who borrowed for these particular facilities are not in a position to repay. That type of risk the bank has taken, we call it concentration risk. So credit risk has two parts. Customer unable to pay, we say counterparty risk. If you have built up large portfolios in one particular industry, we call it a concentration risk. Now, remember, we studied what is credit, then we also studied what is risk. Then now I come to the management. To manage, we need to know the process. Because I told you management is planning, organizing, implementing, and arriving at the required results or the objective. So to give you a better idea of that, I put this slide. I call it a credit process, and I have divided that into two parts. What you could see on your screen, the left side, you will have credit risk management. So in this slide, I told you we are identifying the entire credit process. Now, credit process I have divided into two components. On your right side, on your screen, you can see credit risk management. Other one is credit management. If you are in the customer service area of a credit department, what you are doing is credit management. If you are in the risk management department, if you are doing credit risk, you are in the credit risk management side. And credit management side, you deal with your customers. Credit risk management is a back office function. They don't meet with customers, but on the papers what you provide by the credit management, they assess the risk. So this is the two difference between these two management processes. Our main idea is to actually do credit risk management, but however, I will briefly touch on credit management, which we have already learned from other presenters. Definitely, you may have learned how to originate a loan, what information you should get from your customer. You may have done financial analysis, and you may have done how to prepare your credit appraisal form, and what securities you need to take, and how you should take those securities, execution of those securities. Then once you give your loan, what type of monitoring is required. All these functions are your credit management function. Those are a business line function. So first I will take a little bit from the business line. You can see a customer approach the bank, or nowadays if you are good enough, you can go to the customer and do a business development activity, canvas the customer, bring him into the bank, and then at that process, if a customer apply for a loan, we call it no overdraft or whatever facility, we call it credit origination. Now you see, This entire process need to be managed if you want to manage the entire credit risk. Why I put on the credit management is on the business line also they take risk. Selecting good customers is part of credit risk management, because if you know a customer whose reputation is bad, he has defaulted other banks, I'm sure you will not take looking at his crib. So that's why I put customer. It's very important that you select credit-worthy customers. Now, credit-worthy need to be evaluated, but that evaluation process is part of your credit management. So customer comes, credit get originated. Credit originator you need to get all the information about customer in order to evaluate. So we'll take a corporate customer. You will ask for company profile. You ask for 3 years audited balance sheet. You ask the names and who are the directors. Then you can check on the clip for their reputation. All that you could. Those informations are very vital if you are to evaluate a credit client. So credit origination requires knowledge to ask the correct information from the customer. I told you corporate client, you ask for 3 years balance sheet. That may not be sufficient. You may need to know what the company does. So you ask for company profile. You can go into little further. You can ask how does your product, what market that product has, who are your competitors, is it you're dealing with one customer, who are your suppliers of raw material. All those questions should be asked at the credit origination level. So under credit management, to know the customer well. So we have this know your customer, but in credit, know your customer is not enough to record only the name and address, take his water bill or electricity is not sufficient. You need to take additional information in order to evaluate the customer's financial standing. So once all those information comes, we do a credit evaluation. Now this credit evaluation also require skill. So that will be done by a specialized, we call it a credit officer or a credit analyst, who will go through all the information what your frontline business has obtained. They will evaluate, they will divide their evaluation into two parts. One is financial analysis. We call it quantitative analysis. That is to do with figures. Based on the information provided by the customer, you analyze his creditworthiness by way of financial analysis. You will check his last 3 years profit. You will check his liquidity. You will check his profitability. You will check his solvency. Various. You may have done this on financial analysis, and you will do ratio analysis to see those ratios are in line with the credit requirement of your bank. Then the other part is qualitative analysis. I told you, you could ask various questions about the product, market for those products, who are the directors. Those are not in figures, but those are qualitative factors. Those are very important, because not only the financials are right, but if the customer's reputation is wrong, or if they are defaulted previously, they will do the same thing to your bank. So it's better to understand the product, the market, who are the directors, promoters, all that. So qualitative analysis, once these two have been done by the credit analyst or the credit officer, he prepares a paper. In bank, we call it credit appraisal form. Now I have put a red arrow in this slide from the credit evaluation to credit risk assessment. That is on the other side of the coin. That is, they move this copy of your credit appraisal form to the credit risk department. Nowadays, central bank requires a joint approval of at least large facilities. So they want not only your business line to look at the facility, they want your credit risk management to look at the facility in detail before it has been approved for customers to be released. At least large facilities, all the banks nowadays, they pass this credit appraisal form to credit risk department for their recommendation. So now still I'm talking on the credit management side. Once that paper goes, and if it has been recommended, it comes back to the credit evaluator. He will present for approval. Once it's been approved, security is required, recommended by the credit analyst or the credit evaluator, will be executed. Now, say if a property mortgage has to be done, those mortgages need to be executed and registered in the land registry. All those processes being done, then only you disburse the facility. I also must say that the process doesn't end there under the credit management. Once you do this approval and disburse loans, you need to review the facilities. At least all the banks review the facilities of loans in a year. But some cases they even review much shorter period. But during the time period until it's reviewed, generally certain monitoring is being done. If an installment is, if you have given a loan and if one or two installments have not been paid on time, then it will go to the attention of the credit monitoring. So then you need to do follow-up. Various other processes will take place when you do monitoring. Now I move on to my process to credit risk management. This I am going to discuss in detail because this is the major portion of our subject matter. We call it credit risk management. And actually I devote the next session, that is next Sunday session, completely on this. But I will give you a brief idea now for us to go into before we do the credit management in detail, because credit management also has a lot of risk which your business unit take. But the credit risk management is kind of a monitoring unit. So they also have different ways of assessing the credit. Now you see, I have put credit assessment here, your credit appraisal form, which has been prepared by your credit analyst or the credit officer, now being passed to that back office function of credit risk management. And first what they do is they will do a credit portfolio analysis. Now you may be wondering, these are, if you are not in the credit risk management, some of these words and terms are maybe a little bit alien to you, but let me explain. Now portfolio is, earlier I told you, central bank has given different type of industry types. So banks also create those sections as their portfolios. Now say, if the industry type is transport, now transport could be loans, leases, various. So banks, if they are given under transport industry leases, we call it our lease portfolio. Under general loans, if you have given pawning, taking gold as collateral, we call it a pawning portfolio. Similarly, if you are under personal credit, if you have given credit cards, and if outstandings on credit cards will consist your credit card portfolio. So it's a portfolio is a base particular industry or section of the bank. So first we will see, when the appraisal comes, these particular facilities belong to what portfolio. Now why I say is, we'll say nowadays you consider tourism is back on its feet, but however, you know, a lot of dangers are there. So if you see a new proposal comes for a new hotel, and the portfolio is tourism. So you will see what is your current outstanding. You will see what are non-performing ratio under this portfolio. Generally, these portfolio reports has limits. Those limits have been set by credit risk management with the approval of the board of directors. So we'll see your bank's tourism sector should consist only 10% of your total loan portfolio, and if your current proposal exceed that, credit risk management will definitely return this particular credit appraisal firm saying that this exceeds the limits being agreed on this particular industry. So credit portfolio analysis that we will also see once moment you present this, credit risk department want to see what type of a loan, to which industry belongs, what type of learnings we have learned from the previous facilities given under the same, whether you have applied those learnings in your evaluation process is the part what we call it credit portfolio analysis. Second part is we also call it credit capital. Now, credit capital is, I need to really move on to the board. Do you see the slide still? You can switch on your mic and answer me. Do you see the slide still?
Yeah, we can see it.
Yeah. Now I am moving to the board. Can you see the board, the whiteboard? If I write something, can you see? I'm putting the balance sheet which I earlier discussed. This is a kind of balance sheet of a bank. This is current assets plus fixed assets will make total assets, current liabilities, long-term liabilities, and equities, the capital of the bank. We originally said 100 billion, and we said about 90 here and 10. Then I divide this into cash, say 7. I also said investment, then I said loans and advances. So this 90 consists of your current assets. Now we are into capital, the credit capital subject. Now see, current liabilities include your customers' deposits. long-term liabilities will include debentures what you have raised, this is shareholders' money. So to give some figures here, I will put in such a way so that your balance sheet get balanced. So now bank has a capital of 10 billion. Out of 100 billion, they have borrowed from your regular depositors 85 billion. These are from investors who made in debentures and the 5 billion. Your shareholders has contributed 10 by way of shares, and the retained earnings will consist of this. Now, what I want to show you in credit capital, there's a requirement by the regulator. Now it is 14%, they say, something called capital adequacy ratio. Now this is nowadays what the central bank is, they want 14%. Now this consists of equity divided by risk-weighted assets. Can you see? Now we have assets. Cash, is there a risk in this? No, we are keeping our own cash. So there's no risk. Some of these investments, if you are made in gold, central bank considers as zero risk. Loans and advances also may consist of loans against your own bank's deposits. Loans given against gold, loans given against treasury bills and bonds. Those also carry risk weight as 0. So though you have 90 here, your risk weight may be slightly lower than 90. So if you have equity of, here we have 10, I would say out of these total assets, your risk weight may be about 80. Put this into 100, you will achieve some figure. Will be about 14%. So your bank will get, you will meet the capital adequacy ratio. That's how it has been done. So what we want to know is, every time you lend, it's very important to see whether it get affected by your capital adequacy. So credit capital is to check when that adjustment is done. Now I want to share further. I will need to erase this. Can you see this area? So I'll try on that. To go further, you need to understand something called credit rating. Now, You know, banks also are subject to credit rating by a credit rating agency. Now we say banks credit rating is generally done by a reputed credit rating agency. We generally, most of the banks uh, provide this particular rating to Fitch. It's an international rating agency. You can even go to other rating agencies like um, ICRA or various other rating agencies are there, but mostly banks go for Fitch. Now those rating agencies will give credit rating. Credit rating is given like this. You can have plus, minus into this to expand this particular rating, but generally it is run from AAA to C. We give your credit facilities if it is AAA. If a customer is AAA, the loans given to that particular customer's risk weight is just 20%. Despite whatever the collateral you have, depending on the rating of your client, this risk weight changes. Now, I want to go a little further. Then I am going to erase part of this. We'll say you have two customers, A and B. These two customers want a facility of, we'll say, 100 million. A customer is a AAA customer. B is a BBB customer. That's their rating. And A customer do not provide any collateral. They want it clean. B customer provide 200 million worth of property. Now, credit risk department has got these two proposals on the same portfolio. They want to decide to whom they should give. Should I give that opportunity to you or shall I explain? Now, AAA customer, 100 million, risk weight is 20%. So, you need in the capital adequacy calculation just 20 million, of which 14% is required. So, 20%, 14% is so you need to only set aside $2.8 million if you give a facility to AAA customer. Your capital adequacy, you need to set aside from equity only 2.8. Whereas BBB customer, risk weight is 100%. So you have 200 million. 100% of 100 million is 100 million. %14 is 14 million. If you give to a AAA customer, you have to set aside only 2.8 million of your equity. Whereas if you give to BBB, despite he is providing security, you have to set aside 14 million in equity for this particular customer. That is what you call credit capital. So banks which has lower I'm going back to slide. Lower capital adequacy, they would like to select AAA customers with high credit rating because they don't need to provide credit capital to that effect. So that will not be checked by your business unit, no, that will be checked by your credit risk department. So credit risk department also have various documents to see whether you follow the rules. Now say every bank has a credit policy manual. Sometimes if you are in the credit management, you are supposed to read this and understand all the rules set by the banks in their policy manual. But while you are doing business, sometimes you don't, though you have read and understood, you don't remember whether this particular facility will be followed under the same guidelines given in your policy manual. Those will be done by credit risk department. So if those have been agreed along with your credit proposal, they also give an independent approval for you to go ahead and execute collateral being mentioned in the facility and then disperse the facility. Credit risk management also has a function similar to review because it's a central bank requirement. At least they say out of large facilities, you need to review at least 35% of those facilities every year. So that function also being carried out by credit risk department. So you need to understand these two processes. Both will take risk. Business unit, getting the customer, doing the loan origination, doing the credit evaluation, also run the risk of not evaluating the customer's creditworthiness. Credit risk department doesn't deal with the customer, but they have your paper, which is credit appraisal form, what you have required. Then they need also to run and see whether you have done the financial analysis right, whether those qualitative analysis, what you said, can be verified. Now, say most of the, if you are in business unit, you would like to give the facility. You will write remarks like this: customer has undoubted integrity. That is not correct because we don't know what will happen in the future. We don't know what is business environment he operates, whether he is very trustworthy, but business could fail. So those could be assessed from credit risk management. So this appraisal forwarding to credit risk management for further independent or recommendation has given our credit process a lot of strength to manage credit risk. So moving on to our subject, I told you earlier, credit risk has two divisions. Now we have understood what is credit, what is risk. We also understood the process of management. Now I'm going forward to tell you do you get disturbance in the voice? Somebody has a discussion, can you mute the microphone? Okay, I will go ahead. Do you hear me? Can someone say whether they could hear what I say. Is slides visible and my voice is heard? Can someone give me an indication?
Yes, sir, we can hear you, sir. You can
All
go
right.
ahead.
Okay, all right. Thank you very much. So I told you credit risk management has two parts. One is counterparty risk. That means your customers, if they default as a result, uh, you will have credit risk. We call it counterparty risk, the customer default. So to avoid that, what we need to is we need to make good credit decisions. We say you need to understand the customers' business, obtain credit information, then
അമ്മേ
you need to follow the policies set by the banks. You need to follow the various credit modules being introduced. So once if you have taken a decision based on those rulings and judgments, you will always make a good credit. So it is better to be attractive to good customers with speed, right channel, and based on risk pricing. So that is to avoid your counterparty risk. So that counterparty risk management is mainly your credit management function, which is done by your business unit. Then we have the second part, we call it concentration risk. I told you if you put all the eggs in one basket and if someone trample it, you will have a huge loss. Similar is the concentration. If you put all your money into one particular industry or one portfolio, and if that sector fails, what will happen is you have a huge exposure, we call it, into that particular sector, and if that sector is not performing, you will have a lot of NPA. That's why credit risk management look at the portfolio, they look at the credit capital, all those functions are done to avoid concentration risk. So you need to understand concentration risk is created by our own, and counterparty risk is the customer's risk, which can be evaluated. So concentration risk also need to be managed if you want to have a good portfolio of credit. So now we go a little faster because these areas you have been already done. Why customers fail? You need to. I divide that into two parts. Individuals fail because either there's unemployment. Nowadays, pandemic, I think unemployment will increase because a lot of people may have lost their jobs or they're partly paid or whatever. Income levels will go down. Definitely, you also have some individuals who will be employed. Rising interest rates of cost of living. Actually, interest rates have come down, but I can't say anything about the cost of living. Cost of living is still rising. Death, illness, medical bills, all understood. Um, if an individual invest in asset like shares, price volatility, price coming down in these assets will have losses. But nowadays, I think share market is doing well, so there is no risk area of people who have invested earlier. Loss of assets without insurance cover, external event occur like fire, burglary, or floods affecting your assets. If there is no insurance cover, definitely you are not in a position to pay back the loans what you have borrowed. So these are the reasons for default. Businesses, your poor sales. If your product is not moving, then if your competitors have taken the market, meaning you have no profits to pay. Change of prices, regulation, technology. Now say we have a regulation. There's import restrictions in the country. We have a lot of vehicle dealers. Prices of vehicles have gone up, so if they have a large existing stock, they can still sell and make money. But regulations are such they can't do new imports. What happens? So the business interruption has occurred. Loss of key customers, suppliers, and employees. This could happen to any business, especially we'll say if you have one key customer, and if that customer decides to do transaction with another business, which will be a huge loss. Mismanagement of cost, lawsuits, disputes, frauds also could lead to business interruptions. As a result, there could be NPA. More reasons I can give: inefficient, poor governance of credit culture. These are some of the reasons within us. Excessive credit concentration, heavy reliance on collateral. Without looking at the customer's cash flow, you think you have security, why not return? But you need to understand that having security itself is not enough to recover your loan. Nowadays, there's an embargo on execution for abuse. So even those customers, if they don't pay back, can't take any action. More liberalized lending practices. If bank decide to, go faster without adhering to realistic valuations and principles, you can
Excuse me, sir.
yeah,
Sir, excuse me.
yeah, sure.
Person who is disturbing is Lakshani. Could you please ask her to mute her microphone? Lakshani.
Lakshani, I think you need to switch off your mic or mute your mic because we could hear a lot of disturbances from your end. Did you hear Lakshani? Yeah, I think. Thank you very much. I think now I think everyone could hear me, right? So more reasons for NPL: lending to low-income borrowers, risky borrowers also could lead to NPL. Considerable lapses in security documentation also will lead to. So these are internal events that could, lead to non-performing asset basis. Now I want to go a little further into how do you do your credit management. In the process, I said two parts. One is credit management. Credit management, I said customer, then you have a loan origination. Now this evaluation. Actually, most of the banks think they have NPL because of wrong evaluation. Now this concept has to be, understood well, because credit risk is taken, and this is the very point where, they take the credit risk. If you evaluate a customer wrongfully or incorrectly, that may definitely lead to a high NPL. So I divide this evaluation into three portions. Before we take a break, I will go until about 10:30, and I have divided your entire credit portfolio into three areas. I put retail credit, I will put as SME credit, then I will put corporate credit, because these three types of credit need to be evaluated in a different manner. You can't apply the same principles what you apply for retail credit evaluation to a corporate client. So therefore, I divide into three. You may have done this before with the other lecturers, so I will go a little faster. Especially retail credit evaluation, you can use a method called credit scoring. It's a kind of a statistical system where you have set a question paper for customers to answer. Based on their answer, you give certain marks. Now, I take example. I would like to apply for a credit card loan, credit card facility. And then you give me a form. In this form, you will write your name, address. Then there will be a series of questions subsequent to that. When I say address, they will say, is it your residence? Is your residence as a mortgage? Based on those questions, the banks will give certain marks. Even if you ask me my contact, you will ask my mobile telephone, office telephone, residence telephone. Now, if I give you only the mobile phone, I may get a lesser marks because then my contactability is not 100% in case of I default. So the banks will give me lesser marks. Similarly, they will ask questions, assets you own. Will say, I have a car. Next question is, if you have a motor vehicle, they will say whether it is leased or there's no facility in that. So if I say it is leased, they know that I have some obligations. When I say residence you own, they will ask whether there is a housing loan attached to it. If it is so, my scoring will get lessened. So this type of analysis, we call it credit scoring. Especially we use this type of evaluation for retail credit. You can't ask this. These are all kind of individual or personal loans. So you can apply credit scoring method, and if you aggregate these marks, what I earned from the questionnaire, and banks have set standards. Now say out of 100, if I have scored 60, they think I'm credit worthy for a retail credit. Then they approve that. So it's a very easy method. You could, even an amateur could do it because you don't need that kind of skill because scores are all known, and depending on the answer, you avoid the points and then you aggregate that and to see whether your standard set by the bank, whether your scores are above that. If above that, you are entitled to that particular facility. Good old days, we also followed another system rather than going to credit scoring. We call it 5 C's of good credit. I think you all know about it. In the previous lessons, I will explain a little further. C's are character, capacity, capital, conditions, and collateral. Now, all these have some meaning. The character is, it's not asking a character certificate from someone known to the bank, but it is to see how trustworthy is this customer, whether you can rely on him. That you need to, check with, either crib report, or if the customer has been banking with you, to see the previous track record. So that is how you engage evaluating his character. Capacity is ability to pay, actually. If he's an employed person, you need to analyze and see whether he has a permanent job, whether the money what he earned, leaving his other expenses, there's a residual balance for which can be utilized for repayment. So that is his capacity. Then capital, we check whether what kind of assets he has. Now, if he says, I have a residence, I have a car, which are not under mortgage, you know that you are not going to take that into as collateral, but you know very well the customer has kind of assets. In case of an emergency, he may be able to liquidate those and pay back the loan. Conditions, now if you are giving personal loans, generally under these 5 C's of good credit, we would like to know what purpose the customer is borrowing, because generally nowadays the examples is personal expenses or personal commitments or whatever. that doesn't stand very good unless, because you don't know whether money's been taken for gambling. So verifying the purpose may be a good idea to see whether it is for a legitimate purpose and the money is being properly utilized to either purchase asset or meet a person's. Nowadays you have this, personal loans taken for travel, leisure. So you may think that's not a good purpose. But in human life, you need to have kind of, leisure time to have a good mindset. So banks understood in such a way that they are willing to even fund that kind of activity. Finally, I come to collateral. Collateral is kind of a assets which is able to pledge. Assets without being properly executed and assigned to the bank has no value. So if all those above are not rightly based on your understanding, banks always need to cover their risk part by obtaining a collateral from the customer. So if customer by willfully or otherwise fail, we need to have a second line of repayment, and that comes from the collateral cover. So 5 C's of good credit is somewhat little difficult for your evaluation purposes, but it stands very good in all type of a lender. Always on a retail credit, they apply this 5 C's of good credit. Now I move on to SME. Those days, when you say SME is small, medium, and enterprise, there's no interclassification of this particular sector. In Sri Lanka, we have our market is mainly consist of small timers. We have big players in the corporate world, but if you pass a town, you can see how many shops are there, how many commercial establishments are there. Big timers also in between there, you can see the supermarket chains, all that. But we have a lot of customers who are set up their businesses individually, and they do trading, they do manufacturing, all sort of things. So this medium and small sector, enterprise sector, has now been divided into 3 areas. We say mass employed, or we very well the macro, micro businesses. Is microfinance, the customers who do self-employment and either do cultivation or do small trade, some manufacturing, are self-managed businesses. They are small, their turnovers are very small. And then you move on to SMEs. In middle, they call it actual classic SMEs, not microfinance, those who have been subject to microfinance, but not very commercial. But in between you have certain customers, and generally this sector, all these, then you move on to commercial. I will go from bottom up. We'll take the micro business. In simple words, we say these businesses are run by mom and pops. That means family run business, generally owner manage, sometimes underserved because banks are not in these villages. They will lack credit, or they will lack required by the banks to provide, like documentation, collateral, they may lack. So probably this sector is being served by microfinance agencies, or even in towns, in villages we have these loan sharks. They give them the loan and then they manage their businesses. Then we move on to classic SMEs. After being in micro business for some time, they have learned their lessons. So they move on to little bit of higher level of trading or manufacturing activity. And they're typically retail sector. They don't do mass production, but once again, the owner manage. And they have been in operation for at least 3 years. So you have been small, but you have mastered that, and then move on to classic SME, usually served by banks under retail banking or customer banking. I will explain in the sense retail banking sense they are not coming to a corporate finance division to borrow money. They will go to one of the branches, open account, and ask for facilities available there. So they are branch dependent. So in Sri Lanka, you can see the banks are opening up branches right around the country, mainly to facilitate this SME clientele. So I would say we have a very large SME market in Sri Lanka, and why the banks are opening branches is to capture that particular market. Once these customers on the classic SMEs in trading for about more than 5 years, they grow, and their asset bases will increase, their borrowing will increase. They become the best customer of your branch. So they are, call it commercial or large SMEs, and usually 5 years and more. Every town we have now so many banks branches. They might not only bank with you, though you have helped him to become a commercial or a large SME. Now they are in a position to do multiple banking. If your bank your branch has a limitation to lend to these customers, and they have various other places to shop around. So you expect this at this stage, they open another account in your competitor bank. Don't worry, because you're going to share the credit risk, because risk will come even at this stage. Business could fail. So even if they open an account with your competitor, don't worry. As long as you do your evaluation right and give proper credit, you should be able to manage your credit risk. So there are high value emphasis on relationship. If you want to retain them, now is the time, because if you think you don't want him to go, you need to give very personalized service to these customers. At that point, bank branches, now they have relationship managers. Apart from your normal credit officer, either branch manager act as a relationship manager and try to retain these customers, because now they are grown. Their activities are little on the high side, and you can give large loans, you can earn more money. So you need to retain them also. But to retain them, you need to provide them better service. So you need to have good relations. Now, SME, you remember, Central Bank also has given a criteria. Any customer who has not borrowed more than 35 million from your bank, any customer who has his annual turnover is not exceeding 600 million, he is a SME customer. Anything above that, he can put into a corporate client, or he will move on to the corporate sector. So all the customers below 35 million borrowing and 600 million turnover is classified as SME. Now we went to credit scoring on your retail customer. Now we say we have a very large SME market, and SME credit evaluation is maybe different from your retail credit. You can't apply your 5 C's of good credit on this customer, because now they have grown a little bigger. Their character, capacity, conditions, and all that has gone differ because they own more assets now. They are in a position to do their own financials. They employ large workforce. So therefore, you need little more kind of evaluation. However, this is the most difficult part for especially branch managers. All they complain, the papers what they present when they go for evaluation of SME may not accurate. You know, the audited statements prepared by SME client, you cannot completely rely on because, you know, these customers have this, you know, fear of, you know, income tax. And generally it is some sickness in our businesses. They think more you show your profit, that you will be liable for income tax. So therefore, financials prepared by these customers doesn't show the true picture of their business. So your quantitative analysis, your financial analysis may be not 100% accurate. So you need to look at the management. And that's why the relationships are very important. You need to visit these customers, understand their business. I'll take for an example. You go to a shop of a SME customer, he may have given you a different set of accounts, but if you go there, you can see a very large stock. And then you need to do his balance sheet by your own. You need to ask various questions from him and build up his P&L by yourself based on the experience and the interview what you do, and then recreate what is due financial by a certain percentage and decide that this is what his actual business is. Now, for example, I'll tell you, you go to a shop, you can ask certain questions like this. We generally, when you go to a branch manager, you call Mudalali and Mudalali kochara stock tina. How much stock you have in yours. So he want to impress you because though in his balance sheet he'll say he has 2 million, he will say 100 million. So then immediately you know that the percentage you need to increase from your financials being provided. If it is 10 million he has provided in the financial, when you say 100, stocks have been need to be evaluated by another 90%, you have to increase. Based on that, you can ask his profit margin, his daily sales, then you can actually build up a P&L by yourself of this customer. So financials versus management, you need to look at it. We have this, if a customer provide collateral, we think he can give this facility. I think that also a very wrong notion of giving credit to SME guy. You need to analyze what is his cash flow. He may not be able to give you a cash flow statement, but you need to know based on, you know, how much his earnings are and build up understanding how much money is being earned as profit in order to repay your facility. So just don't go by just because customer has collateral, and if he's not generating enough cash by way of profit, he may not be able to repay your loan. Past record versus future prospects. Now again, these SME guys actually, when they start, businesses have a lot of difficulties. They fail. So maybe the past records will not be a good judgment in order to give future credit. If he brings a good proposal with ability to implement that proposal and do that project, I think sometimes we need to, forget past records. If he has one or two installments not paid on time in the past, shouldn't be a criteria for his evaluation. Company versus industry. Now, say this particular SME small companies, maybe in industries like, we talked about industry, I took always example of tourism. He may be a small hotel in the tourism industry. Despite the pandemic, this hotel may be still in operation, which has large local customer base and still operating well. So the industry may not be doing well, so we may not need to judge by the same standard this company, this particular business. So we need to identify his operations. So that's why SME need, good relations if you need to evaluate their facilities. So SME evaluations need lot of willful, lot of skill and lot of gut feelings. So that's why the experience is need from your credit officer or the credit manager to evaluate SME credit. It is slightly different from retail credit, but you don't have proper financial records or the accurate financial records like corporates to do financial evaluation. So there's a lot of qualitative factors has to be built in the evaluation of a SME credit. Before we go into corporate credit, I would like, we'll take a 20 minutes break. So we'll be refreshed to go forward in our credit evaluation of the corporate customer. So I'll meet you in 20 minutes. We'll move on to our corporate credit evaluation. We tried retail evaluation under credit scoring and 5 Cs of good credit. Then we said SME evaluation need a lot of judgmental and gut feelings depending on the industry, finances, management and various aspects. When you come to corporate credit, corporates are being audited annually. They are supposed to file their accounts in the company registrar, and they have to appoint a auditor who has a good reputation, and auditor also responsible for correct and accurate information. So based on that, what you get from a corporate, if you get audited statement, you could assure that you are getting your financial statements are right. So therefore, we follow certain model. This is a model which I follow. I call it 4-step model. It's a kind of a lender's approach. We ask, why do you want money? The purpose, how you are going to pay back. Then we evaluate the risk what the company runs, not the bank runs. Payback will get affected if a company is subject to various type of risk. And if those risks are acceptable to us, then we know that company is in a position to pay back us, therefore we give. Not only we give, but we structure the facility according to the cash flows so that we will get at regular intervals our repayment. So the 4 steps are the purpose, payback. Here we are going to touch on the risk more because that's where our subject matter is. We want to know what type of risk and corporate get subject to. Like we looked at what kind of risk the bank is subject to. So similarly, you are lending to a corporate, we need to know what kind of risks they get subject to. As a result, their repayment get halted, and then we run the credit risk. At all these 4 stages, we can actually avoid the credit risk if we have done properly. So we looked at the purpose first before going to risk. What kind of purpose do you think a corporate will need money for? I would say most of the corporates generally ask for working capital because they have other ways of getting capital for their long-term activity. Like, shareholders will fund it. Corporate can issue commercial paper. So not only borrowing from a bank, they have other means of, obtaining credit nowadays. Therefore, especially for long term. So most of the corporates ask for working capital. That working capital means your current assets minus your current liabilities. That portion has to be funded by banks. Now, say if a corporate runs a large stock and they have large debtors, whereas people who provide credit to that corporate is lower, that means their creditors are much lower compared to the debtors and the stock. There is a gap. That gap need to be funded by a bank. So that comes by way of a working capital. What else? What could be other purposes generally corporate will ask generally from money from a bank? Corporate also can ask money to finance purchase of a long-term asset, a building, a machinery, a plant, whatnot. That kind of a asset which will generate income over a period. Mostly project loans are to fund certain assets. So we need to do analysis in a different way. If that's the purpose, we want to know.
Excuse me, sir.
So the purpose can be for working capital, then finance of an asset. Generally, most of project lending is to borrow money to fund the asset. It may be a plant. Generally, that type of evaluation, you go for project type of lending, you need to do evaluation differently. That is, you need to see the payback period of a loan, your internal rate of return, that kind of application you can apply. Corporates also might ask you, I want to see how you react it if someone can answer. If says we want to liquidate an existing facility. Now say you have a corporate client who banks with another bank also. Let's borrowing from another bank, we'll say 100 million. He comes to you and say, okay, my purpose is to actually pay back my loan from the bank B. Can someone tell me how do you react? Do you allow that kind of facility? Just simple yes or no, because there's no right answer. I will explain to you why you should consider that facility or not to consider it separately. Can anyone tell me if you get a corporate client and he comes and says, my purpose is to pay back another loan from bank B. How do you react it? Don't worry, there's no right or wrong answer here, but we will see why we should consider or not to consider that facility. Madhushankar, are you there? What about Kasun? What do you think we should allow that sort of a purpose as a facility? I didn't get a reply, but I will tell you, corporate lending is based on the corporate's balance sheet. Now say, if you have a corporate customer, if you looked at his balance sheet, under his borrowings, which are liabilities of that particular balance sheet, you will have higher value than what you have already lent to him. That will give you an idea that he has borrowed money from elsewhere. So, but however, you have given the facility. You see, still having that amount of borrowing, customers still make money, good enough to pay you back. So if he comes and says, I want to settle bank B, I need this money. If you look at balance sheet, even if you give, the balance sheet will not do any changes. There's no variation in figures thereafter because the borrowing is going to be same. Only the place you borrow differs. So if you have been happy earlier, I don't think absorbing that loan also will create a problem for you. So that's how we looked at in corporate lending. We also call it balance sheet lending. So sometimes you might get purposes of this nature from a client. So you need to see the balance sheet again, because corporates will always bargain for the best rate what they can take. If they have taken a loan from bank B, we'll say at 10%, and if you have given them at 9, they would like to even convert all the borrowings to 9, because that 1% will create a huge profitability for the corporate. So we need to evaluate those purposes. So main purposes will be for working capital, asset financing, and then also kind of liquidation of another liability. So sometimes all those are good reasons for you to think of corporate lending. Then we go to payback. Payback, how does a corporate pay you? They say in good old days, bankers, especially corporate bankers, even in their dreams, they think customers' profitability. And customers' profitability is not good enough. They want to see cash flow profits. That's why we ask in a corporate, we ask some statements, financial statements from a corporate if you want to lend. You ask for 3 years balance sheet. You ask for profit and loss account, or nowadays it's called income account. We ask for another document called cash flow statement. So corporate will give you an idea how does the cash flows will be there for future repayment. Then also you ask for another statement which actually they are supposed to publish it, change in the equity, because every year equity can change. You can have a retained profit going to that, you can have shareholders get right issues. So in a financial year, equity can change, and as a lender or an investor would like to know how the equity has changed, because equity play a major role in the solvency. So payback, look at payback, how does they pay is mainly from cash flow profits. It's not only profits, profits could be book profits. You will run a huge debtor list and show a large profit, but the money has not come. Subsequently, those debtors become bad, money will not come. So what the bankers believe is, bankers want to know profitability based on the cash flow. Someone on the microphone can, if they can mute the microphone and answer the home queries, I appreciate, because it will not disturb the rest of the members who are following this program. So payback, mainly cash flow profits. Now I go a little bit radical, and I will say, a customer come and say, I'm going to pay back by liquidation of assets. You may wonder now whether it's a right kind of thinking to lend money to this sort of a customer, because if we can make profits, we are very happy. But if he says he's going to pay back a loan based on a liquidation of assets, once again, I want you to think that corporate lending is balance sheet lending. Now, you will have a customer who has a balance sheet. In that balance sheet, if he says he has a large property, however, his factory is situated in, say, 20% of that property. Rest is, just grown up, and he will be just spending money for clearance of all those weeds and whatever. So he has idea, to develop business, but his thinking is he don't need those land which are not generating any income, which has become an idle asset. So he will say to you, my thinking is I may need to sell this property, part of the property which is in the balance sheet. Probably, maybe the entire property is mortgaged to you. Based on the proceeds of that, I will pay. So it's a liquidation of assets. So that kind of thinking also you need to reconsider, because in a company, non-earning asset is a burden to the company. If they are not generating income, it's useless having it in the balance sheet, because the company's thinking is, if you are thinking that the value will go up and retain that for future revaluation, it's in order. Now, we'll take for a consideration a construction company who has done a apartment complex. So his assets become those apartments. If he comes and says, I want to sell apart number 10 on the 10th floor, you may think he's liquidating his assets. Actually, that is his industry. The assets have been created by his own business. Unless he sell it, he may not be able to pay back. So sometimes customer will say the liquidation can come from sale of assets. You may have to think, what is these assets, whether that asset is required to run the business, or it's an idle assets which will not generate income. Then I think bankers, we need to agree. Now, those are two pre-runner to our 4-step model. But here, what we need to look at is mainly the risk, because that is our program. So I will go into the next slide to see what the risk a particular company, any company could run. You see, when I put this slide for bankers, we draw 3 circles and we show operational risk, financial risk, various other things. But in a nutshell, a corporate runs financial risk. Of course, that's why they prepare financials. And investors, based on financial, do investments. Bankers also look at, before lending to them, all their financials. So if they have financial risk, generally we don't touch. But they also run other risk. Macro conditions, the environment they operate, you may have already studied, will affect their business. Macro conditions include pestle factors, political, economic, social, technological, and all those aspects also will affect businesses, including inflation, interest rate, exchange rates. All those will affect a company's progress. And the others is ownership and management. Then we also have company has certain particular business risk pertinent to that particular industry. So what we are really looking at is those risks in the business and also financial risk, because we are going to do a financial analysis, and your qualitative analysis, quantitative analysis, mainly based on the finances provided by the company. So Rest of the things are all qualitative aspects, which has no ratio calculations and various others. Once again, you may have done ratio calculations, so you may be familiar with what are the financial measures what a bank would like to ascertain before they lend to corporate. Financial risk, generally what we looked at is we want to see whether the company is profitable. Sufficient funds are always there to meet their obligations. Then we also looked at the stability over a period they have going as a going concern. So we have certain approaches we call financial ratio analysis, and ratio analysis will be done for liquidity, solvency, the funding strategies, funding instruments, efficiency, interest cover, profitability. So I will pick some of them and show you further. We'll look at liquidity. This is a measure. Liquidity means company's ability to convert current assets into cash. It's very simple. I want to show here. I'll go to the board and we'll draw up a small
Excuse me, sir. We can see the board.
you can see the board, right? Okay. I'm going to erase some of the things which I wrote earlier. Simply, I'm going to just write company's income statement. We say sales is the topmost item. Then you deduct cost of goods sold. Then you get gross profit. Then you deduct selling and administration expenses. Deduct depreciation. What you get is earnings before interest and tax. You deduct finance cost. You get earnings before tax. And you pay taxes. You get net profit. So this is generally a trading account of a customer. So we go into balance sheet, you will have, not like the bank balance sheet, you will have current assets, which will have cash, debtors, you will have stocks, then you have fixed assets, land and building, machinery, etc. You get total assets. You have current liabilities, mainly creditors. Then you have long-term liabilities, sometimes debentures. You have capital, equity. It's your total liabilities. So this is companies in a nutshell, the balance sheet. So liquidity means we have this norm called current ratio. Current assets divided by current liabilities. Generally, as a banker, what do you like to see this? If I say you have twice as much as current liabilities, are you happy? Okay, you see these are the two current ratio, the liquidity ratios. Liquidity means right. So we take two ratios, which is current ratio. Current ratio is current assets divided by current liabilities. I took some figures and show you. If current ratio is say 2 current assets to 1 current liability, is it in order? Because most of the bankers think that should be the way when we fund working capital, because we need to see that they must have a large current assets than current liabilities at least 2 times in order to make a working capital loan. Does this apply to everybody? In trading companies, generally we will have, like what I showed you in the board, a large stock, large debtors. That makes their current assets larger than current liabilities of an institution. So as a result, generally, sometimes it is 2:1 or even much higher, requiring a lot of funding by way of working capital. So that means if it exceeds 2:1, that means they need more working capital. If it's less than 2:1, if they don't have current assets, what happens is funding them will create the over lending situation where they have no assets to liquidate or sell and pay you. So going below 2:1 on a trading company, bankers generally believe it's not advisable. But now the things have been changed. You have to need to look at in a corporate customer. Those stringent 2:1 doesn't apply anymore nowadays, because businesses have transformed their ability to fund themselves. I would like to take an example of a large corporate in Sri Lanka. We'll take Cargill's. If you see last year's their account, maybe published in the web. I did this somewhere in 2019, I think. Their current ratio is 0.38 to current liabilities of 1. So it's also a trading company. What they do is sell items in their mainly supermarket chains. So their current ratio is 0.38. That means they have only 0.38 assets compared to amount of money what they have to pay to customers is 1. So which is for a banker kind of a disturbing ratio when you look at it. But if you look at their business model, that is quite normal and it is very acceptable, because reason is that company have more liabilities. That means all the items in their stores are taken for sometimes for 90 days credit. So they build up huge liabilities. All suppliers need to provide them 90 days credit. So those items are being sold even prior to the settlement of the creditors. And so they build up cash on that, and they don't lend, they don't give on credit, because if you look at a supermarket, when they sell, either they sell for cash or for credit card. Now, when they sell for credit card, very next day they send those papers to the bank concerned and get their money. So those monies, they don't keep in their current assets. They use the supplier's money to build up another stores. And even that stores, suppliers will go and give credit. So when this process goes, their business model is such, they don't need to borrow money from the bank in order to fund their growth. The suppliers are giving. The suppliers of goods are giving money because they give longer period of credit. We call this suppliers credit. If you can build up a business model of that nature, those are very successful and they will not carry current ratio 2:1 what the bank expect. We have similar companies in Sri Lanka. We will take, for example, Dialog. Now say the Dialog has 2 types of services they provide. They provide post-pay and prepay. So actually most preferred for them is prepay. Before they give the service, they take your money. That's why those cards are being printed or preloads are being done. They get their money. They have not provided the service. So they don't have to account for that. Those monies are actually paid in advance for the services what the customers expect. So they don't have debtors. Instead of that, they have customers who have paid money, so they become creditors. And so they have large liabilities than current assets. Still, those business models are very good and they make a lot of profits. So we need to understand the business model in considering these 2 ratios also. In a general situation, 2:1 is very good because you have enough and more assets to pay for your current liabilities. What we look at is liquidity means whether the company is in a position to meet the obligations of creditors or the current liabilities. So if you have large current assets, it's good enough. But however, some companies with their various business models, they don't need to have that. Instead of that, they take prepayments, they get suppliers credit to develop their business. Quick ratio compared to current ratio is similar. Current assets, less inventory. Inventory is stocks. So you leave out stock and look at the assets. And if that assets could be equal to current liabilities, 1:1 is good enough. But here we need to be a little mindful of 2 things. When you consider your current assets, we consider the customer's debtors, and also we consider customer stocks. Now, you are not sure whether those are given at the realizable value. Now we'll take, for example, you have current assets, debtors. You have a whole heap of debtors. We'll say company runs into 90-day. This particular company, they have a term of credit. We'll say they tell their sales rep, you can only provide up to 60 days credit. And within the 60th day, money should come. That's the company policy. But you get a statement from the company. We generally, bankers ask for, when you fund working capital, you ask for additional financial statement called age analysis of debtors. And you also ask, what is the company policy on credit? If the company policy says we only give 60 days credit, and if you get a debtor statement which has more than 60 days credit, that means anything over 60 days is bad debt for them. So you need to actually take out those items which are longer than 60 days and consider them bad debts, and then do the calculation of your current ratio. Similarly, stocks. Company can give you, banks ask for, if they are funding working capital, they ask for another additional statement called stock statement. Why do you ask for stock statement? Is to see how good, how tradable is this stock. There may be damaged items, there may be obsolete stock which cannot be traded. However, they are showing in the assets. So if you're going to fund against those stocks, you are not going to get your money back. So additional statement of stock statement, and generally banks ask for either monthly or quarterly stock statements to verify whether those stocks are tradable. Otherwise, you may have to ask the company to take all the obsolete and damaged stock out of your current stock statement and give us the correct figure in order to calculate the current ratio. So two other factors which will come when you come to liquidity. Not only you need to verify the balance sheet and the P&L, but also you need to verify age analysis of your debtors of the company, and also stock statement to verify are there any obsolete stocks. So this is where this measure, not just a calculation, you need to go a little further and see the customer's business module, whether we need to understand whether the age analysis has been taken to verify bad debts. We need to identify stock statements have been taken to verify obsolete stock. If all this been done, the customer's liquidity position will be correct. Otherwise, you run the risk of, company runs the risk of liquidity. As a result, when you lend to this particular company, bank runs the risk of credit. So we move on to another analysis, solvency. You don't like to lend money to a company which is either considered bankrupt or going to be bankrupt. So we need to see whether the company is in going concern. That means which has enough shareholders' money to pay for at least long-term liabilities. Generally, you can borrow money for your short-term liabilities, which are your debtors and creditors, and debtors and stock. But if you have long-term liabilities, which like long-term loans, debentures, need to be verified against the shareholders' money. Now, we call this in a different terms. We call it solvency, we call it leverage, we call it gearing. All these are meant to verify whether the company is in a position to pay the long-term debts out of the shareholders' money. So generally, banks like to lend on a long term. We'll say if a customer comes and asks for a project loan, we calculate a ratio called debt-equity ratio. So we looked at the customer's long-term debt at that time, and we looked at his shareholders' contribution, and we'll do a comparison. And based on that, we do the lending. Now I'll take example and ask you a small questions. You can either answer this or I will provide the answer thereafter. I come for a project loan, and you do the evaluation of my project. You are happy, you may have done IRR or internal rate of return, then also you looked at payback period, all that project facilities what you have learned earlier you may have done, and you consider my facilities good. Then when you look into gearing, you looked at me and says, your debt equity ratio is 3:1. That means on this project, I provide 25% and I want 75% bank to provide. We'll say 100 million project, my contribution as share is 25 million. I'm asking for a loan of 75 million. Are you happy with that ratio? 3:1. Generally in project lending it is like that, because banks would like some kind of contribution from the project owner, which is generally standard as 25. So long-term liability is should not exceed more than 75%. So it is in order. But you go to the last line, I have put your gearing current and long-term debts compared to shareholders' equity. If you put current and long-term debts, you will never get 3:1, because current liabilities include amount of money provided by banks on a short term, suppliers credit, all that will include in the current liabilities. So it will make up very large amount compared to the borrowing of you make. Now in this case, why I put current is, if you put only the long-term liabilities, nowadays money which need to be borrowed for long-term items, most of the customers are use this through short-term facilities. As a result, bank will not be able to really judge whether the shareholders' contribution is sufficient. So you do go a little further and see, include the current and see what will be the percentage. Now when this comes, all the liabilities have been included, so 3:1 will not be achieved. But however, you will know certain portion of total liabilities could be met from shareholders' equity. So in a going concern, as long as shareholders' equity can be used to liquidate some of the long-term liabilities, we say company is solvent. Now we go to another analysis called profitability. Now you may have done this in your ratio calculations in with other lecturers. I do run a small understanding. I consider profitability has two versions. We looked at how profitable is your sales. If you are a company, you can, if you have looked at my profit and loss account, you have gross profit divided by sales will give you a gross profit margin. You divide net profit by sales will give you a net profit margin. That is not the company's profitability. That is how profitable is the company's products have been sold. It will give you profits, but that is not only the criteria you need to analyze in giving facilities to a company. I want to know how profitable is your company. If you have large amount of assets and your profits are very small, your return on assets, if you go down, ROA, may be lower than what you think in your operating profits are. So net profit before tax or net profit after tax, you divide by your total assets, will give you a return on assets, which also a measure to see how profitable is the company. If return on assets are minus, that means your assets are not generating income. You will have idle assets. I will do a small comparison of two companies in the same industry. We'll take Dialog, which also telecom in the telecommunication industry. We'll take SLT, another giant, which has a very large asset base because they have large set of fixed assets by way of buildings in all areas, all those transmission posts what they have in all over the country. Those investments are very large. You compare to Dialog, the asset base is maybe about 3 times to 4 times compared to Dialog's assets. Now you take net profit of SLT and Dialog. I can remember in 2019, Dialog made 10 billion profits compared to SLT made about 2.8 billion. Whereas SLT has a very high asset base, so the return on assets is very much high on Dialog. So as a company, Dialog is more profitable than SLT, though they have a very large asset base. But what I mean is, most of the assets what they own are not generating income. So Dialog would have been helped by their business model also. SLT provide mostly fixed lines and postpaid. Dialog going little further, they reduce their finance cost by taking customers' money before they provide the service by prepayments and use that money without having to borrow money from banks. They use that money to do their business. So you need to look at return on assets as another kind of measure in your financial analysis of profitability, apart from normal profitable of your sales. Return on equity is another measure because your investors need to be happy, and this also need to be positive because if a return on equity is less than the fixed deposit rate, your investors of this particular company will think, why should we buy shares of this company, instead put money in a bank and you earn more interest. So that's the understanding of the profitability. So financial risk is analyzed at least in these 3 areas. I'm not going to other areas which you have already done. Efficiency is about managing stocks and debtors. So if a company is profitable, if their sales are profitable, and if their return on assets are shows higher value, those are the companies you should think lending. Then we also looked at liquidity. If the current assets, the business model is not that, and if a trading company can have 2:1, if debt equity ratio is 3:1, we consider those are in good ratio analysis to lend money. Risk factor is lower for us to consider. Efficiency ratios also you can look at. Asset turnover ratio is sales divided by total assets. Now see, Dialog and what I said, Cargill's what I said. When you take their sales are very much high. Total assets, they don't have debtors. much because they don't give on credit, but they buy their goods on credit, but they don't sell on credit. So as a result, they can show good asset turnover. Similarly, debtors turnover, inventory turnover, stock turnover. You can apply that to creditors also as a credit turnover, the creditors turnover. These ratios will give you the efficiency of the company. Now, efficiency is generally looked at a cycle called cash cycle. If you draw up a cycle, you start with company having cash. That is at the top. Then you move clockwise. With this cash, you need to borrow raw materials. And part of that cash being used to borrow raw materials, some part you get creditors. Now these raw materials, again, if you go by way of clockwise, has to be turned into finished goods. That process we call work in progress. And then you move the circle further. Work in progress will give you finished goods. Finished goods will be sold for credit. You get debtors. And then debtors will be realized. You get cash back. We call this cycle a cash cycle. The faster you can turn this clock, more efficient is your company. That's how bankers looked at it. If you can make your raw materials quickly into finished goods and don't provide finished goods are being sold for cash, you get quickly cash. Now, there are companies in the world, they consider efficiency is the most important area for them to be successful. Like you take Toyota. Now, Toyota has a term called they don't have stocks, they don't have warehouses. Their method is called just in time. Now, they are manufacturers of vehicles. They need huge number of parts to build a car. And so their suppliers come from different parts of the world, and they have one assembly line in a plant. And probably Toyota must be making only the engine and the chassis, but doors, lights, various other instruments come from different parts of the world. So what they say is they don't want to bring those parts and stock and create that cash cycle longer than what they think. So they open LCs and they tell their suppliers, my chassis is going to go into the assembly line on a particular day, and lights are needed in 10 days after that. So they don't buy lights, they ask the supplier to provide the lights for this particular vehicle on the 10th day of their manufacturing process. And that is we call just in time. So they avoid insurance, they avoid warehousing charges, they avoid salaries paid to storekeepers due to this just-in-time model what they follow. So efficiency also required factor to avoid credit risk, because a company, if it is efficient, which they can turn the cash cycle faster, you get cash quickly into the company and then will be able to repay your facilities. So that's how we looked at the risk factors. We have some credit rating agencies can apply this type of model to consider the profitability of a company and solvency, the growth, the efficiency ratios and size to decide the facility on a system in a computer. So what does this particular model called Moody's KMV risk calc is bank gets 3-year statements of a company. They input that into a system. System runs the ratios of profitability, solvency and growth, everything. And then they give us a points for banks to consider. It's like the scoring model, what we did for retail customers. You can run another model created by these credit agencies to verify the financial ratios, the financial aspects of the company, to decide the credit to that particular company. Because I told you in the first place, corporate credit is actually balance sheet, mainly based on customers' balance sheet, because we could rely on the figures what is being given. But generally, like the 5 C's of good credit, balance sheet alone will not be good enough. You need to understand other type of risk which company faces before giving the facility. So we are going to look at other type of business risks, mainly the business risk. Now you remember the risk categories, risk types faced by bank. We first said strategic risk. Now similarly on a company, strategic risk is a very big risk. If the company's strategies are wrong, their product will be eaten by their competitors in no time. Not like in banks. Our products are all same. We give fixed deposits. Our loans are maybe you, whatever type you do it, it is same. And the interest rate we could charge is or more or less same with compared to our competitors. But in a other competitive world of business, if you don't have better position than your competitor, you will go down in no time. So your business models are important. You may have heard of this Michael Porter's theory called competitive advantage. That means you draw up a circle and you put your company and you put your competitors into the same circle and see how good are you against your competitor. Even if you stand above your competitor, that's not good enough, because in a competitive world, you have another 4 arrows pointing at you, your company. In this Michael Porter's theory, they say your business can be taken by substitute products. You may develop a product, but a substitution can come. Will take your product away quickly. I can give you a small example. We'll say if you are a manufacturer of champagne. Champagne is a very unique product. Generally, we use champagne at these marriage ceremonies and all that. You have this champagne fountain, and the couple comes and put the champagne into the glasses, and the hotels also do certain tricks. They put some hot water and make a huge glamour out of the situation to create some photographic scene out of the situation. But now this champagne is an expensive drink, and to waste on a situation like that is insane. Now, those days, when you say champagne fountain, you get the real champagne. Do you think now you get real champagne on the champagne mountain in these marriage ceremonies? I don't think so. Now there's a good substitute for champagne. It's the same color, which gives the same sparkling effect of a champagne. They produce now sparkling wine, which will be a great substitute for champagne at even 20, the cost may be even 20% of a champagne bottle. So now all these places, they don't use champagne. So you just see the substitute has taken their business away. Similarly, new competition also can come. If you start a transport agency and if you make huge profit, a lot of people who want to do business will also get into the same business. So competitors can creep in, but like banks, it's not very easy for a newcomer to come, because regulatory requirements are licensing, other things are there. But any other businesses, sometimes very easy to get in. You start a software company and you can, if others come to know that you are making good money, you can rest assured within a year another 5 or 6 companies will start the same business. So competitors also might take your business away. So your strategy should be to beat the competitors, beat the substitute products. That is not enough. I said 4 arrows. You can't lose your customers on one side. You need to give them the best service, quality goods. Otherwise, they can find better suppliers. You need to arrange regular supply of raw materials. So you need to have very reliable supply at a lowest cost what you can get your raw materials. If those things are not being met, your business strategy is lost. So Michael Porter's this competitive advantage theory is to build up those strategies. Somebody might ask from you, if you're a bank, if they ask, I don't know what the answer you're going to give, what is your USP? This question been asked from most of the companies when the CEOs been interviewed, what is your USP? I have given on this slide, USP stands for unique selling proposition. Unique selling proposition is should always differ from a similar company in the same business. We'll take for a bank. If they ask what is your unique selling proposition, bank will really struggle to answer this, because you will say, I also have product, I have branded my product. But the major unique selling proposition for a bank is the customer service. If you can differentiate the customer service from your competitor bank, you have a unique selling proposition. Otherwise, if you provide the same kind of, you provide online banking, if your competitor also provide online banking, it is nothing. You should be able to provide online banking in a different way than your competitor does. Otherwise, you don't have a unique selling proposition. So business risk, mainly the strategy. So you need to ask your companies which you go to lend, what is your USP? What is the advantage you have your competitors? What is your business model? Can we have a profile of your company to see what is your market share in the same kind of, same type of industry? The other business risk is the earning dynamics. Is you can manage your cost, because most of the companies, if they don't have a regular supplier who has been fixed with the price, if that supplier losses, if you go for new suppliers, your cost will increase. If you can't manage your cost, mainly companies' profitability will go down. You have heard this, BRS, banks also does this. Voluntary retirement schemes. If you have a large number of staff, which will be a burden, because the cost is going to increase because you need to pay salaries. That's why those companies have this VRS. So you need to really balance your operations and to input correct cost and labor cost. It can be material cost or whatever, in order to maximize your profit. So earning dynamics are also very important factor in considering the risk of your customer. Then the asset management. I told you about, cash conversion cycle. Then I told you about debtors, age analysis. I told you about stock statements. You need to know whether the assets, what they generate income. I told you, you can have a large fixed assets, but if those are not contributing to your sales or profits, then it's no point. It's only the balance sheet size, but I compared Dialog and SLT. Dialog asset base is much smaller, but their profitability is very high than the own competitor SLT, who is a giant. They have big assets, but those assets are not generating money. Their return on assets is low. When that goes, the business risk get increase. Then we also looked at management and ownership. I have put another model here, not like the Michael Porter's theory. I put 4S theory, the structure of the company. Sometimes a banker can ask, can we know your organizational chart? That is to see whether they have the correct people here. Now, you know, most of the companies, they have CEO. Latest addition is COO, that means Chief Operating Officer. Then we have CFO, Chief Financial Officer. So those structures have been created to manage the company proper. So if those structures are in order, you know that companies will do well. Then the next is the strategy we have already looked at, systems. Some of the companies need to be really updated in their operations. Once again, I can give you an example. Sometime back, I went to a company and it was a corrugated manufacturing industry. What they do is they feed in the raw paper, and some stage they get the kind of a cardboard. To make boxes from there onwards, it's a labor process where, you know, you employ large number of labor and then it become a manual process. But nowadays you have systems and machinery. You input paper, you don't, in between you don't get the cardboard and paste and do manual. Final product will come at the end. So if you have that kind of systems, you are well above your competitors and you are very cost effective. So the risk is minimum in to lend to such a company which has the state of the art technology so that they make higher profit. Skills is the others. You need people with skills. Sometimes, you know, change of CEO even can affect the share price of a company, because if you looked at, if there's a newspaper article say the Coca-Cola CEO has resigned from the company, I would say in US market, the stock prices might go down, because they will not know who is the new CEO going to be, and his capabilities and skills are not to match with the current CEO. Investors get little panic, and as a result they will sell, and as a result stock prices will come down. So this management and ownership also to be considered before you lend to a company. Then the macroeconomic factors also, I also said, exchange fluctuation. If you are a company which is an importer, your price of goods abroad is going to be the same price as before. However, if the rupee depreciate, you need to adjust that price to see the devaluation of rupee. Because if you bring an item which is $1, 3 months before it is say 185. If you bring now and if it is 200 rupees, you have incurred additional cost of 15 rupees. If you are unable to sell in the local market that higher value what you have incurred in your exchange, you cannot make profits. So these macroeconomic factors also will be a risk factor for corporates, and you need to consider what type of, whether raw material is being used, whether they have agreed on a price, and whether they have kept margin for exchange fluctuations. I hear news item yesterday that you cannot even do forward contracts now. So the importers find it difficult to get a rate or their imports. So these are the kind of risk factors generally banks will have to consider. This is the last item which I'm going to go into details today. Now we looked at credit, what is risk, what is management. We looked at the credit process, and in that we have covered the risk credit management side. We looked at evaluation part, we looked at retail evaluation, we looked at SME evaluation, we looked at in details the corporate evaluation, and we identified the risk of the customer. Now, if those risks are higher than what you think, if there's a problem in generating future cash flows correctly, banks need to have some kind of second repayment arrangement. As a result, we need to get some kind of security. Now, these risks can be mitigated by not only collateral, there are also something called covenants. Now, you understand if you are in credit department, when a customer comes for a facility and you give if you allow that facility and you give a letter of confirmation, we call this letter offer letter. All the conditions about this facility is been listed in this offer letter. Now, I know you're a bankers. Your bankers have borrowed money on your housing loan. That's one of the privilege we all bankers have to borrow money on a lesser interest rate from our own organization. So, best thing is to go for this housing loan. Moment you're eligible, I know bankers will apply for this. Some banks give you at very minimum interest rate, but they give you an offer letter. Have you looked at, and this offer letter you need to sign because it's part and parcel of your security documentation in the file. They give you this offer letter in duplicate and they ask you to acknowledge, and you need to return the original to them and you retain the copy. I want you to go through this offer letter once again if you have already obtained. In that, you have mortgaged the house. It says, so you have provided the collateral. But apart from collateral, there will be some conditions. I'm sure one of the conditions will be you need to maintain the assets in good order or in good state of conditions. Your asset is your house. Why that statement is how the condition is being put? You cannot remove windows and doors and sell it. That's what it says. You need to sometimes insure against fire and burglary. Why? Those are actually covenants. Those are certain terms and conditions which will give additional strength for the bank in case if you are unable to pay. You also take another additional, very additional collateral which is for the bank, which is called insurance cover. Mortgage cover is there already, but apart from that you get debt repayment cover. Debt repayment cover is to in case this particular insurance is in case something happened to you, the money will come to the bank from the insurance company, because we have this culture, they can't throw you out from the house, though they have the mortgage, but they say mortgage protection cover from an insurance company will give you the bank additional advantage. Those are actually covenants. So covenants can be either financial covenants or they can be certain terms or the rules set out in this offer letter. Collateral is actually an asset, we mortgage, and this mortgage get registered in a particular registry if it is land, in the land registry. Other way you can minimize risk is the price you charge on your lending facility. Now, how do I explain? You take a credit card facility and you take a housing loan facility from the same bank. You are the same customer. Consider how much they charge if you left a balance in your credit card. It can be about 18 to 24%. Whereas your housing loan will carry a 4% interest. Why is this? The price you pay for your housing loan and the price you pay for your credit card is two different rates. Because the risk in your credit card is higher than your housing loan, which has been protected by various other mortgages and mortgage protection covers, whereas credit card is not so. So banks used to charge more. So by the time you default, bank has recovered most of the cost by way of higher price. Risk has been mitigated through the price by charging you more. There are other financial covenants in the slides, you can read it. The financial ratios. Banks can even implement saying that you cannot, your liquidity has to be maintained 2:1 all the time. Your debt equity has to be 3:1 all the time. So when you provide financial, if you have violated this, bank has the right to recall the facility. So these are certain covenants bank can apply. Collateral also you need to be vigilant that it need to be able to locate, and has margin should be steadily increasing. You take a land and in a location, the price is going to go down when there's a crisis. If you have lent more than that, you will be in trouble. So it has to be easy to realize. Pricing, I just told you about two difference in, so pricing also will give you advantage. I'm going to stop right now, and this is the last item on the credit management, because I need to draw a lot of attention to specialized credit. Other than specialized credit, here I am going about trade finance. It's the import-export financing, which I leave because I don't want to overdose you with a lot of things for one day. And next day we'll start, because this is the last item on the credit management, and once you finish this, we are going to start on the credit risk management. With that, we're going to complete our module, and if possible, I will do a question paper, so that question, because it's not a paper, I'm only able to provide one question for this particular credit management module, and in order to make you easy to pick up that question to answer in your exam, I will take one question also from a past paper, and we'll discuss how it can be answered. So for today, I'm going to conclude the presentation on this, and next Sunday we will take up the special credit, which is the last part of credit management. Then we move on to credit risk management, and then we'll do a question for you to make your exam easy. Thank you very much. I will stop sharing from now. Any questions? I think you can do it. I think there is facility for you to ask questions on this particular concept. If you post any questions, I can take up at the next meeting, next time when we meet, and I could answer some of them. So you can write up any questions if you have from today's session. So we can take up first thing next time when we meet. Thank you very much and have a good day.